Good evening, everyone. Thank you so much for tuning in to this year's first edition of Virtual Office Hours. Today, we have a super exciting conversation around how institutions are quietly reshaping the cryptocurrency market. If you have any questions throughout our discussion today, please be sure to add them into the comments and such, and we will address those toward the end of our discussion. We have three great panelists here today to break down what does cryptocurrency mean for institutions, how it is changing the ecosystem, all in light of the recent VASP Act that passed here in Kenya last year, and different things. So we got Marius, we got Keega, and we got Apollo all joining us here. I'm going to hit a quick 1-minute countdown so people from all locations can join the room, and then we will get started. So thank you guys so much, and looking forward to the discussion. Good evening, everyone. Thank you again so much for tuning in to today's conversation of Virtual Office Hours. Our discussion today is around how institutions are quietly reshaping the cryptocurrency market. We have a great discussion and great panelists who are coming on board from Luno and from Keega and Company. So I'm the CEO of the Kenyan Wall Street and co-founder of the Wall Street Africa Group. We're so excited to have you here for this year's inaugural discussion. So to kick us off, I would love for all of my guests to give a quick introduction about themselves, what they do, their specialty. So please allow me to welcome Marius Reitz first from Luno. Marius, could you please introduce yourself?
Yes, thank you, Andrew. Thanks for the opportunity. It's a pleasure to join you and your audience tonight. My name is Marius Reitz. I'm the General Manager for Africa and Europe at Luno. I'm dialing in from Johannesburg tonight, or this afternoon. I joined Luno in 2016, my 11th year in the cryptocurrency market, and my road has taken me to all the corners of Africa, and that has been the greatest privilege for me to help Luno build out the digital asset infrastructure in Africa. So yeah, I look forward to this discussion. Thanks.
Thank you so much. Now I'd love to jump over to Apollo Sande. Apollo, tell us a little bit about yourself.
Great. Thank you very much, Andrew. Great pleasure to be here with you today. My name's Apollo Sande. I am the country manager for Kenya at Luno. I have been in the crypto space since about 2012. First joined Luno in Kenya in 2014 when it was still called Bitex. Still going strong, very excited about the potential of crypto in unlocking opportunities in Africa.
Thank you so much, Apollo. And finally, Keega. Keega, tell us a little bit about yourself and what you do.
Wonderful. So as Andrew has intimated, my name is Keega Gakuua. the managing partner of Keega Company Advocates, and a vocal advocate for virtual assets here in Kenya. In fact, my firm was part of the delegation that was trying to get a lot of incentives for the virtual asset space, specifically in terms of the finance bill, as well as in the taxation element. Thank you for the invite. Looking forward to a productive and engaging conversation.
Absolutely. Thank you guys so much. And, if you're tuning in throughout the course of this discussion, if you have any questions, please be sure to put them in the comments. We'll have a Q&A toward the end of the hour where we can go through many of the questions that you have. We're currently live on LinkedIn, YouTube, and X, all for the Kenyan Wall Street and such. So I'd love to kind of kick things off. And maybe this is a little bit of a general question, but I know, Keega and Apollo, you guys are here on the ground in Kenya. What have been some of the recent developments in the cryptocurrency virtual assets industry that brings us to where we are today here in Kenya? Who wants to take that?
I think I can.
All right. I would say, first of all, okay.
Apollo, I think we may have some internet issues on your end. I don't know. Maybe it's my end. Keega, do you want to kick us off?
Yes, no problem. And so I think in Kenya, we have had a very interesting journey in terms of how compliance has been viewed, as well as how institutions have been able to operate in this quote unquote novel on asset space. And so in that respect, we have had a lot of interest in virtual assets even before 2010. But we began getting a lot of activity around virtual assets in around 2015. And the same was crystallized by a matter that had been brought forward by Safaricom, where they were suing a virtual asset service provider for providing Bitcoin here in Kenya. And so from that beginning, we now started to, one, have the discussion of virtual assets finally come to the public fora, where we were now actually discussing the merits or lack thereof in terms of its usage. And so a direct result of that is that you had the CBK circular coming out later that year saying that cryptocurrency has been deemed to be speculative and that therefore Kenyans should desist from trading in the same. But regardless of that circular, there was still a lot of interest and a lot of Kenyans who viewed virtual assets as a viable option versus what we've been used to in the traditional financial space, especially in terms of dealing with intermediaries, settlement speeds, as well as the cross-border nature of virtual assets. And so from that time, we had another incident where WorldCoin came into Kenya and they were recording some private information. And so at the time, they were issued a license by the Office of the Data Protection Commissioner. But the same was cancelled on account of the fact that they were collecting information that was deemed to be too sensitive. And so in that respect, there was a lot of scrutiny around how virtual assets are going to operate in Kenya. And from the activities of WorldCoin in Kenya, there was a parliamentary committee that was convened where all the stakeholders were given an opportunity to essentially say exactly how they'd want virtual assets to be regulated in Kenya. So these are the traditional financial regulators such as CMA, CBK. We also had security agencies such as NIS and DCI being involved. And more importantly, we also had some communications agencies being involved. And so this was the first time where there was an actual concerted discussion from the various sectors of government to try and figure out how they could deal with cryptocurrency. At the same time, the CMA came up with a CMA regulatory sandbox in 2019. And the import of the sandbox was that it was meant to help innovative products or services get onboarded in the Kenyan ecosystems, but under very specific requirements or circumstances. And so with the sandbox coming in place, it provided an environment where some certain classes of crypto products could be traded. And so as a direct result of that, we started seeing some certain classes of virtual assets begin getting legal recognition. And so, for example, some companies that were dealing with real world assets, such as Alpha Block, were admitted to the sandbox. And now, after that, we started having discussions. And one of the recommendations from the parliamentary committee is that Parliament needed to come up with a law. And so, after a very long period of trying to come up with this law, both in 2024 as well as in 2025, we finally had an act coming into force in the last quarter of last year. And now what we're waiting for are the regulations that can be able to provide more clarity on how the specifics are meant to operate.
Okay, thank you so much for that rundown. I think that kind of brings us up to date. But Apollo, you were trying to say something earlier. I was curious. I want to hear what you were going to say.
All right, great. Thanks, Andrew. I hope I'm audible. For me, it's been a very interesting. It's been very interesting to see the shift in the industry from speculative trading back in about 2013. People hopping onto Bitcoin, every other coin that came through the various memes, ICOs, NFTs, into now we're talking about crypto and blockchain as infrastructure, right? And then seeing a maturation of the players along the way from, small time mining, trying to offer trading accounts, now offering serious corporate infrastructure, doing serious capital raises, building big multinational teams. It's been very interesting to see how the industry and the players in the industry have evolved in Kenya.
Okay, thank you so much for that. Now, Marius, I'm curious, our discussion is about how institutions are changing the market. I'm curious, from your point of view, what have you seen in regard to institutions? Are they becoming more open to looking at stable coins or cryptocurrency, whether it's an asset class or a utility? I'm curious, what have you seen from your side?
Yeah, thanks, Andrew. I think being based in Johannesburg, I think I'm definitely closer to the institutional action in South Africa and on the African continent as opposed to in the UK and other parts of Europe. I think the SA, South African, and also the African crypto market punches above its weight. And we've seen institutions in Africa, but also in South Africa, entering the market over the last 2 years. And I think one of the watershed moments for the South African industry was the introduction of a license regime through the Financial Sector Conduct Authority in South Africa. That was in 2024. And since then, we've seen more than 300 firms obtaining or receiving the crypto asset service provider licenses. Now, of the 300, the vast majority of those firms are traditional financial service providers, large financial advisory service businesses, asset managers, commercial banks, investment banks, and the like. So I think that it really is a really strong indication of the intent and the interest in the market and the direction of travel, that there's a strong demand for digital assets, whether it's from an investment perspective. I think that has been established, and we know that now from the success of the US ETFs, the BlackRock ETF, Fidelity, Grayscale, etc., and the fact that those ETFs have accumulated more assets under management or at a faster pace compared to the gold ETF, which BlackRock launched in the early 2000s. So I think the demand is clear. As Apollo mentioned, the infrastructure is being built real time to unlock more efficient, cheaper payments for institutions, whether it's cross-border remittance or whether it's more proactive strategic treasury management. So we're seeing a lot of that currently. And in South Africa, Luno partnered with Discovery Bank, which is a major South African financial institution. And so that's more on the B2B2C front, but we're enabling Discovery to offer their clients, their banking clients, access to digital assets. Last year, ABSA, large bank with a presence in Kenya as well, announced partnership with Ripple to offer institutional grade custody to institutions in South Africa, also in direct response to a strong institutional demand. And then we also saw asset managers like Signia and Discovery Invest launching Bitcoin funds last year. So I think the direction of travel is quite clear now. There are some key differences between South Africa, and Europe. I think in Europe, similar to the US, the regulations and the underlying regulatory system permits the listing of crypto-backed ETFs, for example. So in countries like Germany and in other parts of Europe, investors can access exchange-traded products, and that has led to pension funds, especially in the UK, to actually take positions to include crypto exposure in the pension funds. So I think if you're for South Africa and for Africa to reach that stage of institutional maturity, I won't say maturity, but to reach that stage of adoption, we need to see some changes and some regulations being adopted to allow, for example, the listing of a Bitcoin ETF on the Johannesburg Stock Exchange, for example. So, but as I said, I think the continent is punching above its weight. Got large institutions that have entered or want to enter the market, and I'm sure 2026 will not be the question of if, but it will be the question of how do we enter the market.
Okay, so we know that South Africa has had regulation around this space for quite some time. Here in Kenya, we don't even have the regulation yet. We have the act. We're waiting for the regulation. But Apollo, I'm curious, in your discussions that you're having with, say, Kenyan institutions, are they showing an interest, and are they looking at this as a category of either investment or utility?
Thanks for your question, Andrew. I would say very, very strongly so. I started hearing about this about 2-3 years ago, before the recent escalation in regulator engagements. Last year, November, I attended a financial education conference somewhere in Nairobi, and 3 CEOs of wealth management companies clearly said they would offer some crypto exposure in some of their funds to their local customers. We've had situations where executives from traditional financial industries looking to play a part in the crypto industry. I think we have recently seen about 1 or 2 deals, even though early stage, inked or motion towards it, where traditional financial institutions are looking to partner or even acquire a local institution that has some sort of crypto infrastructure. So yes, I think in Kenya, it is going to happen a lot faster than we can imagine. There is a lot of pent-up demand from financial institutions.
Okay, interesting. Now, Keega, on a little bit more of the legal side, oftentimes when it comes to an institutional investor, one of the first things they have to consider is this concept of fiduciary duty and fiduciary responsibility in regard to protecting their investors and such. How are you seeing with the VASP Act, maybe even with the incoming or upcoming regulation, how do you believe that issue of fiduciary duty is going to be addressed properly?
Yes, because when you're looking at financial regulation, especially with the capital markets and with the Central Bank of Kenya, you are looking at 2 sides of the spectrum. On the one side, you're trying to look at market penetration, where the intention is to facilitate an ecosystem that is going to have innovative products and services. And on the flip side, you have market protection, where you also have an obligation of protecting the money that has been held or is being invested by various parties. And so, what the regulator is trying to do is to, one, apply some of the traditional methods that have worked in the past. For example, elements such as capital and solvency requirements, things like insurance, elements that a company may need to maintain given the risk exposure that it might have. Another important element are things like fit and proper tests. So, who are these individuals who are actually engaging in the business? Have they been tried and tested? Have they been convicted of previous financial crimes? So, such considerations are important in terms of looking at the stability of the space. And the beauty, or both the unfortunate bit around it, is that for us to survive in this particular space, one of the biggest incentives for our customers is trust and stability. And so, in that respect, it's always important to ensure that that is never lost to us, especially when you consider cases such as FTX.
Okay, yeah. I know the collapse of FTX is still on the minds of many people who look at cryptocurrency. And, I think that brings up an interesting distinction that, even though it's been repeated so many times, people don't realize is there is a difference between an exchange and a wallet. I'm curious, either Apollo or Marius, do we just want to go through some of the quick basics?
Yeah, we can, definitely. So, I mean, well, if you really want to get technical, then you can start to differentiate exchanges and wallets. We see ourselves as a crypto platform that provide, our customers, whether it's individuals or institutions, access to, the ability to custody the assets on Luno, the assets. And we, as Apollo said, we've been around since 2013. We had 0 incidents around hacks or theft of customer assets. So I would think a wallet infrastructure enables clients to safely and securely store their crypto assets with Luno or with a cryptocurrency platform. And then on the exchange side, it's all about trade execution and liquidity. So that's where you enable your clients to convert the Kenyan shillings, South African rands, Nigerian nairas into crypto assets, right? And the important components, they are safe and easy to use fiat deposit methods. So customers must be able to do bank transfers very quickly at low cost, at 24/7, 365 almost. And then they have to be able to access deep liquidity on the exchange. And I think that those are all kind of the building blocks, right? It's the custody component, it's the ability to transact in or to purchase crypto assets with local fiat currency, and then access to deep liquidity so that you get really good pricing on your crypto assets, and that customers can also take large positions, and that's particularly important for institutions. So I think those are the core, the core value propositions of a crypto exchange or crypto wallet, whatever you want to call it.
Okay, and I had seen news before we started that Luno recently launched something in South Africa. I'm curious, Marius, if you want to take us through that briefly. What is that?
Yeah, so I wouldn't say it was a Luno launch. Luno is merely a partner in the launch. So Luno, in partnership with Easy Equities, retail and institutional investment platform in South Africa, Sanlam specialized asset management services as the asset liability manager, and then also Lesaka and Moore as the independent auditor, launched a rand-backed stablecoin. So I'm sure we'll get into the details of stablecoins still, but I really see stablecoins as a direct response to the broken parts of the traditional financial system. And I think Luno and all these partners, which are some heavyweights, I think 3 or 4 of these partners are all publicly traded companies in South Africa, and came together, and we said that this is an area that we want to address, and it really points to inefficiencies in the processing of payments, whether that be local payments or international payments, unacceptable delays in transactions, cost inefficiencies, And then also the unpredictability of fiat currencies across many emerging markets. And so we believe that in ZARU, which stands for ZAR Universal, we've built the infrastructure in South Africa to start addressing that problem. So we're very excited about this. Currently, ZARU is available to institutions. So institutions can register their interest on zaru.co.za. And it's available for purchase through Luno and through Easy Equities trading desks.
Okay. Thank you for sharing that. You said that's ZARU, Z-A-R-U?
Z-A-R-U, yes.
Interesting. Maybe one day there'll be an opportunity to do a shilling-backed coin. I'm gonna just leave that there and not ask any more questions. But Apollo, I want to come. Sorry.
Certainly.
Okay. Apollo, I want to come back to you. Now, institutions, as we had mentioned earlier, always have to prioritize safety, auditability, and such. How has Luno evolved its Kenya platform infrastructure to meet these trust requirements and these reporting requirements that, say, a traditional Kenyan asset manager would demand?
All right. Great question, Andrew. Luno has central services, right? And then we have local entities, locally incorporated entities across various markets. And we have long had the foundational core capability to offer both retail and institutional services. Remember that we already operate in 2 regulated markets, and in South Africa, we already engaged with financial institutions, providing institutional grade products, and therefore Kenya, even though early conversations are beginning to happen in Kenya now, but as soon as the licensing frameworks, regulatory frameworks are in place, we will be able to offer the capability that we have built and expertise that we have built over the years in a number of markets. So to put it in short, Luno is actually ready to provide institutional grade products in the market. It's just a matter of when regulations are in place to begin executing such deals.
Okay. Now, Keega, on this topic of regulation, the addition of regulation up from little to none of what we've had in Kenya for a while, now moving to a more regulated environment. I'm curious from your standpoint, do you see this as a higher barrier to entry? Is that a deterrent? Or do you actually see that higher barrier to entry as a green light for institutions? Keega, are you there? While we wait for Keega to get connected again, I'm curious, Marius, Apollo, do you believe these new regulations are a good thing for the industry, or do you feel it will hold people back?
Probably just before Marius goes, and I think, I would say the regulations are necessary. We know the history that crypto has undergone, often associated with, breach of trust and losses along the way. And for it to go mainstream, institutional, customer trust has to be front and center. It needs stability. Institutions are not going to engage with the crypto industry unless there's some sort of stability, there's predictability. And therefore, the only way for crypto to expand into mass market and institutional capability is by having supporting regulatory framework. And remember, the traditional financial industry has been around for quite a while, has developed and evolved guardrails, have fields, guardrails within which they play. And therefore, the crypto industry will be required to measure up in order to compete in serving the same customers or partnering with them to serve the same customer segments. So while there may be friction, I don't think regulation is a fast sprint. You'll never get it right at the first instant. It'll take time, but they're a critical first step. And I see as the Kenya industry is already evolving to be able to engage regulations and regulators more maturely, more professionally, more productively. Therefore, I wouldn't position the regulations as I'd position regulations as an enabler overall, with friction to be resolved.
Okay, Marius, do you agree? Regulation as an enabler or inhibitor?
No, well, I think Apollo's made some good points. I don't have much to add there. What I can add though is that plays an active role in engaging with regulators globally. We spoke earlier about our presence in Africa, but we also licensed business in Southeast Asia, in Malaysia. So we were the first cryptocurrency exchange to obtain the digital asset license in Malaysia. So we share our learnings from engaging and obtaining licenses and engaging regulators in markets all over the world. In Africa, so we bring that same knowledge and experiences and best practices and learnings into conversations with Kenyan regulators, with South African, Nigerian regulators, Ghanaian regulators, and I think we have got that responsibility to try and nudge the industry in the right direction, and I think that's one of the main responsibilities that we take as well.
Okay, Keega, you're back. You can hear us.
Yes, I can.
Good. Then I want to circle back to you on this question because Apollo and Marius have answered it. I think you're going to answer in a similar fashion because I think we're all agreed on this. But with the rise of now what we will have as vast regulations, I hope we didn't lose Keega again. Maybe. All right, maybe we'll find a different question. I think that may be a haunted question. Hey,
Hello.
you can hear us?
Yes, I can hear you. Apologies. I think in terms of I think in terms of looking at regulation, it was important for us to arrive at the act because it was a document that a lot of stakeholders had tried to negotiate upon because there are so many opposing interests trying to essentially achieve different outcomes. And so it was a very difficult process to get to, and I'm glad that we finally got an act. But at the same time, the regulations is where the rubber is going to meet the road, because that's where the practical considerations are actually going to be present. And so in that respect, I think the actual battle begins this year, where we are going to start looking at the public participation elements, as well as looking at how both bigger players as well as smaller players can operate.
Okay, interesting. Now, Marius, I know I've recently stumbled across this concept of corporate digital asset treasuries, essentially where companies are holding digital assets on their balance sheet, say as a hedge or as just a liquidity asset. I'm curious, from your standpoint, are you seeing more African companies, African corporations considering that and moving in that direction beyond just fintech startups?
Yes, Andrew, definitely. I think in 2015, already the discussion shifted from if to how we as corporates use digital assets like stablecoins as strategic treasury management tools. In South Africa, for example, last year, a publicly traded company on the JSE called Altvest became the first listed company to acquire 1 Bitcoin. They've since rebranded to Africa Bitcoin Corp, but it was really the first company in SA to take that step, the first publicly traded company. On Luno specifically, we've seen a sharp increase in business account applications and openings from sole proprietors to larger organizations. And I think for the majority of these companies, the objective is not to speculate, but to hold crypto as a hard inflation hedge. In Bitcoin, you have an inflation tool, which I think is one of the most traded assets on Luno still in Nigeria, South Africa, and in Kenya. And you have stable coins as a treasury tool, to facilitate the payment of suppliers. And we see many large corporations inquire at Luno, especially on our trading desk, where we can facilitate large trades. And the interest so far this year has exceeded the inquiries for the entire 2025. So we're currently in discussion with multiple large listed companies in South Africa and Nigeria specifically, who I think have been forced to explore stable coins or digital assets as strategic treasury tools. And I think many of these companies have realized the risks of leaving 100% of their liquidity trapped in a single currency in an emerging market. So yes, sharp increase in demand. Many large corporations with foreign subsidiaries that have trapped cash in those markets that need to access those cash and access their working capital. Many companies that also take positions in crypto assets also as an inflation hedge. And as I said on Luno, we can provide institutions and individuals access to those assets, to stable coins, to deep liquidity, through an exchange order book, but also through a trade desk, professionally run trading desk. So if there's any interest from institutions, they can find us.
Okay, interesting. Apollo, what are you hearing here on the ground in Nairobi? Are corporations, different financial institutions, are they looking at cryptocurrency and stablecoin options as either a inflation hedge or as a tool for liquidity?
Thanks, Andrew. Yes, from about 2022, 2024, when we had a US dollar liquidity crunch, and I think the shilling depreciated against to about 160 shillings per dollar. Traders needing to make cross-border payments began adopting stable coins because they were accepted by their counterparties overseas, which drove creation of the over-the-counter trading market in Kenya. This industry is already maturing. The traders, the OTC providers, growing cross-border, but as they grow, they begin to engage more local corporates, begin showing the value proposition of having stable coins, both for trade settlements and for treasury purposes. So it's a bit of a virtuous cycle where demand drives capability drives more demand. But even beyond the need of stable coins for cross-border payments, I know at least one firm setting up to provide corporate treasury services with crypto. Yes, so that is happening.
Okay, interesting. Now, Keega, we had a lot of news in recent months about the Genius Act in the US and several other things. I'm curious, when you were advising maybe a client, how are you kind of taking into account global regulatory movements and global businesses, and then in relation to changes in Kenyan law as well in regards to looking at this industry?
The advice is pretty clear at the moment because we are dealing with three different types of laws, so to speak, at the moment. If you're a Kenyan VASP, that would imply it would be the Virtual Asset Service Provider Act, and then the regulations that are going to be coming in force later this year. In the US, you're looking at the Genius Act, and in Europe, you're looking at MICA. And so in terms of strictness, MICA is going to have the strictest requirements in terms of regulation. while US is going to be slightly lax, while Kenya seems to lie somewhere in the middle. And so if you want your company that is operating within all these jurisdictions to be able to comply within each jurisdiction, then it's important to view compliance and regulation both within silos as well as looking at the bird's eye view. So for example, what are the specific requirements that the Kenyan company needs to maintain? What are the specific requirements that you need to maintain under MICA? And what are the specific requirements that you need to maintain under the US Genius Act? And then it's important to also maintain a legal checklist that is able to maintain all these nuances so that you can understand where the differences lie, where the similarities are, and where you can also be able to leverage on arbitrage opportunities that exist. Because when you're looking at the regulations as well, in the same way that you have financial arbitrage, is the same way that you could have regulatory arbitrage, where companies can be able to make use of some incentives that operate within certain jurisdictions but not in others. And so I think it's important to view it both in the point of view of the silo of each particular jurisdiction, as well as viewing it holistically, so that the legal department can be able to ensure that all the T's have been crossed and all the I's have been dotted.
Okay, interesting. I know when I was working with a previous company, we were talking about data policy, and the big thing they kept bringing up was like this concept of a regulatory common denominator, which is you pick kind of the most stringent common denominator. If you're operating in the US, Europe, and Kenya, you'd pick the most stringent regulations from each of those jurisdictions to follow. Am I correct kind of in assuming that that's what a lot of multinationals are also looking at doing?
Yes, but at the same time, as I mentioned, there's a lot of incentive and opportunity that lies in the regulatory arbitrage space. So what I mean by that is, for example, when you're looking at data protection, a fine for a company might be capped at 5 million shillings, while a fine in Europe is almost going to be without a cap. And so in terms of the things that a company would be willing to do in Kenya versus what they'd be willing to do in Europe, that would be vastly different considering the resources that would have to be deployed. And so I agree with you, but at the same time, it's also important to look at that lens as well.
Okay. Yeah, thank you for that. So regulatory arbitrage then is I guess, maybe one of the words of the day. Now, jumping over, to the Luno team again, one of the big discussions in the fintech industry across Africa has been, the African Continental Free Trade Agreement. And with that, there are mechanisms that are being put in place, such as PAPS, the Pan-African Payment Settlement System. Of course, this, is more of a traditional financial infrastructure, but what we're seeing and what I think each of you have mentioned today has been, the utility of using stable coins and such in cross-border transactions. I think all of us have sat there waiting for days for a transaction to clear because maybe it's coming from Uganda to Kenya or somewhere else. And so I'm curious, do you foresee stable coins and using that as a utility of transaction? Do you foresee that as potentially challenging the traditional financial ecosystem that is being built across the continent?
Yeah, maybe I can take that. So I think I don't think stablecoin adoption in Africa is necessarily driven by the need to decentralize everything. I think it's in response to constraints that we've discussed that companies and individuals face doing business, not only in Africa but in emerging markets at large. We know what those constraints are. It's almost the trifecta of friction, which is the unpredictability of US dollar liquidity. It's the cost inefficiencies associated with international payments. Between 7 to 10% of the value of a payment evaporates in the form of fees, and then also unacceptable delays. And you pointed that out. So So I think the value proposition here is undeniable, and the proof is in the data. We've seen data from Chainalysis that shows that in 2025, more than 40% of all crypto transactions in Africa came from stablecoin transactions. We know that the major remittance companies, the card networks are, almost all of them at this stage are using USDC for settlements in the back end. And so I think in 2026, what we will probably see is we will again move from a wait and see approach to the start of regulated rails potentially. So we're seeing stablecoin regulation in the US in 2025. I think that provided a lot of direction to African regulators, and in countries like South Africa and Nigeria, we may see regulation enabling banks potentially to integrate stablecoins into their core banking apps. And we'll also see corporates shifting from using stablecoins as a pure hedge play, as a currency hedge, to more active treasury management. For example, I mentioned earlier, corporates with companies with foreign subsidiaries, for example. So I definitely see that shift happening in 2026. For institutions wanting access to stablecoins or the infrastructure, there's some important building blocks. I think firstly, compliance and risk management is really important. So the cryptocurrency platform, like Luno, they need to ensure that from a compliance and risk management perspective, all the boxes are ticked. Because some of these are multinational, large, regulated businesses. Then we spoke about trade execution, which is really important. And then also the ability to deposit and withdraw funds, so having access to funds. Those all work together to ensure that the cost, there are cost efficiencies, and then there's also time efficiencies. So yeah, I think 2026 is going to be a big year for stablecoins in Africa, and again, driven by need and not necessarily by greed, as we've seen in some of the other crypto assets.
Okay. Interesting. I mean, I guess one of the big questions people have right now is like, what is going on in the crypto market globally? I'm curious if either of you want to, touch that question.
Yeah, I mean, I can start. Apollo, I mean, please also stop in, and please also add. So I think, Andrew, so pre-2020, 2022, thereabout, I think the primary drivers of the crypto prices, I think, were social media influencers, celebrity tweets on Twitter, etc. So it was more driven, I think I would say, through greed factors potentially. 2024, 2025, and 2026, I think we're entering a more fundamental phase where we're seeing institutional capital entering the market. The US ETFs, as I said earlier, I think those were the catalyst for institutional entry into the market. And the primary driver now is shifting from what I mentioned earlier to regulatory compliance and regulatory approvals. So that's enabling a lot of institutions sitting on the sidelines. We sat on the sidelines to now into the market. Now, market commentators talk about the death of the 4-year cycle, which was largely a retail-driven narrative. So the 4-year cycle refers to the Bitcoin halving, and usually, shortly or 1 year after the Bitcoin halving, there's this notion of a supply squeeze, and that then impacts the Bitcoin price, and the rest of the market follows. So I think that's changing, and probably again to increase institutional inflows with more sticky capital, so capital with longer-term mandates. And the expectation is that will probably dampen out the volatility that we experienced in the market in previous years. Now, you might say, now what about the current volatility? I do think that we are seeing a rotation in capital currently from crypto into commodities like gold and silver. Both of these commodities have currently experienced all-time highs, and they are on a big rally. And I think this has led to capital returning potentially back into commodities. If you want to refer to them as almost as the old guard, the OG of the safe haven assets. In 2026, we'll probably see, and we've seen that already, the convergence of, for example, commodities and digital asset infrastructure in the form of tokenized gold and tokenized silver, for example. So digital assets like for example, PAX Gold, or Tether Gold, Tether Silver, I think will become more prominent. I think it will give investors access to 24/7, 365 investment, instant liquidity, fractional ownership, which is really important in emerging markets. And all of those assets are currently available through Luna as well. So, yeah, I'm not sure, Apollo, if you have anything to add.
Great, thanks, Marius. On a global level, I think institutional adoption driven by regulation clarity, increased connectedness, is leading to deeper adoption of crypto assets and the core blockchain technology, things that we envisioned would be enabled by blockchain technology, many years back. Things like accelerating capital formation, decentralizing ownership of assets, driving financial inclusion, bringing cheaper global transactions, enabling more digital trades, including for humans and autonomous agents. All those things that we speculated many years ago would be enabled by blockchain technology are now coming to the fore as more legitimacy enters the industry. And I think it may not happen in the way we initially envisioned back then, when the thought around crypto was, more rebellion, more reactionary. I think now the opportunity to create is increasing. Some products will be available, some not. Very, very interestingly, there was a discussion around privacy coins, while they may be shared on one side, we see another one launching recently. Yes, so overall, I think the potential of blockchain technology and crypto is now coming to the fore as more players enter the market with more capital and capability.
Okay, interesting. Now, I want to jump over real quickly to Keega again, because I'm quite interested in the concept of real world assets. I know one of the discussions around the cryptocurrency and stablecoin industry has been, how can you leverage real world assets on a digital token? I know one of the common discussions on this has actually been around real estate. How can you tokenize real estate and such? So Keega, I'm curious, do you foresee that becoming a thing here in Kenya, where, you can buy a, say this developer's coin or such, or do you believe that the regulation may not allow for such creativity?
Maybe before I answer the question, it's important for us to maybe look at the promise that real world assets provide. So when you're looking at a typical land transaction, especially here in Kenya, you're looking at a completion process of around 90 days. That's 90 days where capital has been locked in and cannot be reinvested in any other opportunity other than that. And so when you're looking at the utility of money and the usage of it, there's a lot of value that is lost in the traditional space. And so on the flip side, when you're looking at real world assets, it's the opportunity to buy an asset such as land using a token that can be tradable almost immediately. And so one of the things that it's inevitably going to result into is a rebalancing of the space as it is, because as it stands, lawyers and other financiers are the players who are the ones who are facilitating some of these deals. And so in the same way that other virtual assets seek to remove intermediaries, maybe the same way that would operate in terms of looking at real world assets. And so the problems that I can anticipate are, one, the issues that it's going to disrupt an already existing traditional market that is, of course, going to be opposed to the full implementation of real world assets. At the same time, you're also looking at things such as ownership. So, for example, when I own 30 units of, say, a building like the PwC building or One Africa, what assurances do I have that the building is going to be managed well? What assurances do I have that I'm going to get a proper return on investment? And so the idea is good conceptually, but how it's going to be implemented in practice is going to be the critical determining factor, because there's also a lot of aspects of trust and stability that need to go into this as well.
Okay. Okay. Interesting. It's always a question of implementation. I always joke, we have so many laws in Kenya. It's just about implementation and enforcement. So thank you for that. Now, we're coming up toward the end of our discussion here today. And so I'm curious, for our audience who's tuning in, whether you're tuning in on LinkedIn, YouTube, X, wherever, please share your questions in the comments if you have those. We'd love to kind of see them and address a few of those. But before we dive into that, I was just curious, on this discussion, we can start with Marius. Do you have any kind of final thoughts? If someone is tuning in just now and has missed everything else we've said previously, what would be the most important takeaway you would want them to walk away with?
Sure. Thank you, Andrew. I think it's quite a skill to summarize a 15-minute discussion in a few short lines. Look, I think the way in which we use money and the way in which we think about money is changing. I think we need to be curious about these changes. I think the amazing part of all of this is that previous revolutions or major upgrades in the financial infrastructure almost happened in many decades ago, right? So in different lifetimes almost. This is happening right in front of our eyes. The financial infrastructure is being upgraded. It's enabling individuals and businesses in markets and regions where the traditional financial system cannot meet their needs. Digital assets and the infrastructure that's being built and that's being offered by the blockchain, I think, is solving those problems in real time. You can almost think of it as a type of the private sector's response to the shortcomings of the public sector or the infrastructure that was built. And so it's hugely exciting. The opportunities it unlocks, whether it's for individuals, Africa diaspora, all the lost value that currently goes towards fees and delays and all the risk and stress and anxiety associated with, for example, remittances. All that lost value can now accrue back to individuals. And for corporates, the ability to conduct their business more efficiently using financial infrastructure that's built for the digital age, whether it's cross-border payments, whether it's more effective treasury management to generate high yield. That's just hugely exciting. And I think Africa is not falling behind the rest of the world. I think there's hugely exciting prospects. We have good quality regulators in Kenya and South Africa and Nigeria and all of these really, really big economies in Africa. And I think, together with companies like Luna, I think we are going to be changing the infrastructure, the financial structure for Africa.
Okay. Keega, I'm curious from your standpoint, if someone's just now joining the call, what's the one takeaway you want them to understand? You there? Keega, can you hear me? Maybe not.
It's only me left.
Yeah, there's not much time left. But I do see we've had, quite a few people saying hello in the comments. So I guess Mr. Patel, thank you for saying hi. Hi. Thank you so much for joining us. We have a lady here who says, been using Luno since 2001. That's great. Or not 2001, 2021. I don't think crypto's been around that long. I see we have Mr. Kennedy who's tuning in from YouTube. Interesting conversation. Thank you so much for tuning in. It's been a pleasure having you guys. If you missed part of this conversation, you can actually find this full discussion on the Kenyan Wall Street YouTube page. So please, go there, take a look. Maybe you'll learn something and such. But I think we're pretty much wrapping up here. Let me see if I can get Apollo back and Keega back real quick just for some final remarks. Apollo, you can...
Hello, yes.
Keega, yes, please.
Okay, so I think for me, I am very appreciative, especially as a person who...
Hi, sorry. Yeah, my internet is misbehaving. I'm excited to see where the industry grows. Goes, especially as it begins to merge slowly with AI and social media. I think that just hit me this morning is we're likely going to see crypto becoming infrastructure. So when you get an app, say it is a dating app, the dating app does not advertise itself as an Oracle database company, but as a dating company, right? And so having crypto and blockchain technology at the back end as a stable everyday infrastructure for a specific use case beginning to emerge. To me, that is another maturation for the crypto industry. And I look forward to seeing that maturation and merging with the rest of the economy continue to happen.
Okay, thank you so much, Apollo. Keega, final thoughts.
I think for me as a regulation and compliance officer, one, I'm counting my blessings because the journey to getting the act has been a very long one. And Bwana Apollo can attest to that. The amount of meetings, nights that we've burned, the midnight oil just trying to get a regulation and an act has been very stressful. But that notwithstanding, we are very grateful for where we've gotten to. But at the same time, as I mentioned before, the true battle lies in where the regulations are going to be implemented. And so even as the CBK and CMA and Treasury open up an opportunity for us to do the public participation, we will continue aggressively and intentionally seeking to get a better regulatory framework.
Okay. Well, thank you guys so much, Marius, Apollo, Keega. Thank you guys so much for joining us today. If you're interested in learning more about this or learning more about Luno, or the great work that Keega and his team are doing, I know you can go to Marius, it's luno.com, right?
Yes, that's the one.
Okay, and Keega, where can people find you?
Keegalegal.com.
Perfect. All right. Well, if you missed part of this discussion, as I mentioned earlier, you can find it on the Kenyan Wall Street YouTube page. Thank you so much for tuning in. We look forward to seeing you in 2 weeks from now for another discussion. It won't be on crypto this time, but for those of you tuning in, we'd love to have you again. We always like to have these thought-provoking conversations that, change industries and impact wallets. So thank you guys so much and have a good evening.
Thank you.
Have a good evening too. Thank you.